The new economy is marked by swift technological advancements, global connectivity, and innovative business structures. This environment opens doors to fresh prospects for both companies and individuals, yet it also introduces fresh obstacles. So, a great investor or economist says that businesses that can embrace and adjust to the modern economy are more likely to thrive. Hey there, Nova Society enthusiasts. You're about to embark on a financial adventure like no other. Stay tuned to the end. Were you aware that an astonishing 1.13 trillion was printed from 2020 to 2021? You might have questioned how Warren Buffett, the most accomplished investor globally, manages the challenging economic circumstances. As we approach a new era marked by significant inflation, increasing interest rates, and a slower economy, it's crucial to understand Warren Buffett's strategies. Today, we will explore Buffett's three-step approach to this new economic landscape. Step 1. Recognize the inflation tsunami. In the vast world of the global economy, there are various forces, shifts, and movements that investors need to navigate. But sometimes
they're having trouble navigating.
One of the most influential and potentially harmful forces is inflation. Similar to a tsunami, inflation can begin as a small ripple in the distance, but rapidly develop into a massive wave that engulfs everything in its path. To truly comprehend the scale of the inflation tsunami, one must first understand its origins. Between 2020 and 2021, an astounding $13 trillion was introduced into the global economy. To put this into perspective, that amount exceeds the entire GDP of China, which is the world's second largest economy. This substantial injection of money into the global economy is next to a sudden surge of water in the ocean, creating the potential for massive waves. So, does this inflation tsunami even affect big businesses? Here's Warren Buffett's take.
Well, we've sort of attacked what you do yourself. And you develop skills that people are willing to pay for in the future, regardless of what the unit of exchange is. But in terms of inflation in our own businesses, it's extraordinary how much we've seen.
Initially, this surge of money appeared to kickstart an economic upswing. Businesses expanded, jobs were generated, and consumers spent money freely. It resembled the way the sea recedes before a tsunami, a misleading calm preceding a powerful storm. Everything appeared normal, even prosperous, but the underlying pressures were building. Warren Buffett, renowned for his sharp insights, once compared inflation to a mugger, a threatening presence that devalues money significantly over time. While the immediate consequences of this money infusion may have appeared advantageous, the long-term outcomes are much more sinister. As more money inundated the market, the worth of each dollar started to decline. This is the core concept of inflation. When there is an excess of money chasing a limited supply of goods,
that's not enough.
Imagine if, all of a sudden, everyone in a town was given $1 million each. Initially, there would be a celebration. However, shortly after, the local bakery that previously sold bread for $2 might raise its price to $20 or even $200. Why? It's because when everyone possesses more money, the perceived value of each dollar decreases. This is precisely what's transpiring on a global scale. Warren Buffett has always stressed the importance of comprehending the intricacies of the market. He once remarked that history has shown us that an unrestricted money supply leads to inflation, and yet people often fail to learn from history. As the freshly printed money circulated through the economy, it began to chip away at the value of each dollar. Think of it like a pizza, cut into 8 slices, suddenly being divided into 16 pieces without enlarging the pizza itself. Each slice becomes smaller. Similarly, as more money chases the same number of goods, the purchasing power of each dollar decreases. This devaluation has real-world consequences. That dream home that seemed affordable a year ago now comes with a much higher price tag. The weekly grocery bill keeps creeping up month after month. The cost of basics like a loaf of bread, monthly rent, education, and even a cup of coffee is steadily rising. While the average consumer may be earning more dollars, those dollars are purchasing less and less. It's like a silent thief that robs people of their buying power. Recognizing the potential dangers of uncontrolled inflation, central banks such as the Federal Reserve intervene to manage the situation. In 2020 and 2021, as the signs of inflation became more evident, the Federal Reserve started increasing interest rates. While this step is meant to cool down an overheated economy, it comes with consequences. Higher interest rates translate to increased borrowing costs for ordinary individuals. This could mean pricier mortgages, car loans, and credit card interest rates. So, the inflation tsunami results from a complex interplay of economic factors, decisions, and outcomes. By identifying early warning signs and understanding their origins and effects, investors can better position themselves to navigate the situation rather than being overwhelmed by it. Step 2. Value and long-term vision in an oversaturated market. In investment, it's simple to become entranced by the allure of fast profits and immediate rewards. The market, with its constantly changing prices and trends, can at times seem like a bustling and chaotic marketplace, with traders loudly vying for attention from all sides, each one claiming to have the opportunity of a lifetime. However, amidst this noisy commotion, the wiser voice advocates for patience and the ability to see ahead. This is the voice of Warren Buffett, and his message is straightforward. Concentrate on the intrinsic value of investments and uphold a long-term perspective.
Investing is really not complicated. I mean, the basic framework for it is simple. Now, then you have to work at it some to find the best pockets of undervaluation, maybe, or something.
Warren Buffett's investment philosophy centers around the concept of value, but what exactly does it mean to invest in value, especially in a market filled with an abundance of options? Imagine stepping into an art gallery where thousands of paintings adorn the walls. Some are bold and instantly capture your attention, while others are more understated. The bold paintings might be the talk of the town today, but will they retain their value and significance over the years? Will they be as esteemed a decade from now as they are today? On the other hand, the subdued paintings crafted by artists who have honed their skills over many years might not be in the spotlight today, but could become priceless masterpieces in the future. The current economic landscape, particularly after the injection of $1.13 trillion, presents a similar scenario. There is a plethora of investment opportunities, but not all are created equal. Some stocks and assets might appear appealing due to current hype or trends, but they lack enduring intrinsic value. In contrast, others, although not in the spotlight, possess strong fundamentals and promise consistent growth over time. Buffett's approach in such a market is next to that of a seasoned art collector who can distinguish timeless masterpieces from fleeting sensations. He delves deep into a company's fundamentals, comprehending its business model, competitive advantage, and growth potential. Importantly, it's not just about the stock's current price. It's about the value it offers in the future, a decade from now and even further into the future. Just like the skyscrapers in New York's Billionaires' Row, the key lies in thorough research. In the information age, data is abundant, but wisdom is scarce. Analyzing a company's financial statements, understanding its market position, and evaluating its long-term prospects are essential steps in discovering its value. It's about delving beneath the surface to find those hidden gems promising long-term returns. Moreover, in an oversaturated market, the principles of supply and demand become more evident. When there's an excess of any asset, its price tends to decline. This creates an opportunity for astute investors. By identifying undervalued assets with strong fundamentals, one can invest at a lower price and benefit from higher returns as the market eventually recognizes the asset's true worth. The oversaturated market may be challenging, but it is full of opportunities. It's like a puzzle, and the pieces, when assembled with patience and insight, can reveal a picture of prosperity. As Buffett often emphasizes, time is the ally of great companies and the adversary of mediocre ones. In the long run, value always stands out, and those who recognize it early stand to reap the reward. Step 3. Financial education in a changing landscape. There's an old saying that you might be familiar with. Give a man a fish, and you feed him for a day. Teach a man to fish, and you feed him for a lifetime. Now let's adapt that saying to our current context. Give someone a stock tip, and you might help them make a quick profit. Teach them about financial education, and you'll set them up for life. This encapsulates the core of our third step, which emphasizes the power and significance of financial education in our constantly changing economic landscape. Picture yourself at a magic show where a magician reveals a deck of cards. After some shuffling and flashy moves, the magician asks you to select a card, any card. If you have some knowledge of sleight of hand or card tricks, you likely approach the performance with a different perspective. You start looking for subtle hints, those small clues, and you attempt to decipher the secret behind the magic. This is precisely what financial education accomplishes in the realm of investing. It demystifies the market, enabling you to understand the mechanisms that underlie market fluctuations. A fundamental message conveyed here is the cyclical nature of economies. Booms and busts are not new. They have existed for as long as markets themselves. However, here's the intriguing part. While we cannot prevent these economic cycles with the right knowledge, we can navigate them more effectively. Warren Buffett, often called the Oracle of Omaha, is a lifelong learner. He dedicates a substantial portion of his day to reading and staying informed. Why? Because he recognizes that in the financial world, knowledge is indeed power. When economic conditions shift, as they invariably do, being well-informed empowers you to adapt, pivot, and make decisions based on understanding rather than fear. Now, let's revisit the recent economic events. With the influx of 1.13 trillion and rising inflation, it's easy to feel overwhelmed. However, here's a different perspective. Rather than viewing these as insurmountable challenges, what if we saw them as lessons in a global classroom? Each event, trend, and shift provides insights and opportunities for learning. The more we learn, the better prepared we become to handle future uncertainties. It's a blend of staying informed about current events, comprehending historical trends, and continuously seeking knowledge. To sum up this step, let's draw wisdom from another piece of Buffett's advice. The most important investment you can make is in yourself. In the grand scheme of things, market trends will come and go, but the knowledge you gain and the wisdom you develop will remain with you, guiding your financial journey at every turn. While this information might be overwhelming, that's the charm of the financial world we're all navigating. With a touch of Warren Buffett's wisdom at our disposal, it does seem a bit more manageable. While maneuvering through the new economy can be difficult, it's crucial to recognize that it brings forth novel chances. By keeping yourself informed, remaining flexible, fostering innovation, and engaging in networking, you can set yourself up for triumph in this evolving economic landscape. Delve into personal finance and generational wealth mastery on our channel. Subscribe now for empowering videos to boost your wealth. Please click on the next video for more financial wealth building strategies.